Hello and welcome to Lewis and Kyle Show, an interview podcast where my friend Lewis and I interview incredible entrepreneurs, investors, and thought leaders in a wide array of subjects.
Today, we have the pleasure of interviewing Nichols. This was a super fun episode. I say that every single time, but you know what? I mean it every single time. Ali is the co-founder at a company called Getaway. They are fractionalizing short-term rental investing with the goal of increasing access to that asset class to anyone who can afford to make $1,000 investment in a fraction of ownership of a short-term rental property. They recently raised $5.9 million from Cowboy Ventures, XYZ Ventures, and Insight Ventures to accelerate their ability to reach this goal. Previously, Ali held senior roles at Bungalow, which is a very similar startup to Airbnb in the space, and also had senior roles at Uber, where she actually managed some of their real estate department. And if you don't know what Uber had to do with real estate, we do answer that question in this podcast. What do we cover in this conversation with Ali? That is a fantastic question. In this conversation, we cover lots, especially at the beginning, of detailed real estate questions about how Getaway works. That's taxes, that's fee structure, that's management, that's the deal flow, that's the tooling they've used to make their lives easier. And I know a lot of you are going to ask how they compare to competition and things like that, and the pros and cons of doing that. We also ask about the marketing and go-to-market strategy for finding the investors. So marketing the properties is you kind of just, make them look pretty and put them on Airbnb, but we discuss how she's marketing to find investors to buy the fractions of the property. Oh, this is what I wanted to say, everybody. I wanted to say, we do ask the question, Kyle does it point blank. We say, what is the difference between this and a timeshare? I know a lot of people are going to want us to have asked that question, and don't you worry, we did. We also ask her about her relationship with her co-founder, what she learned working at Uber, and also, again, how she plans to compete with other big players in the industry like Fundrise. Of course, we say this in every episode, hopefully, with episodes like this. This is not financial advice. I don't know anything. Kyle, do you know anything about finance? No, he doesn't. This is just education. This is just entertainment. We are not professionals. We're simply two dudes hanging out, having fun, chatting with people who are starting businesses, etc. That's all I have to say before we get started. I know you're going to enjoy this conversation with Ali because myself and Kyle both did thoroughly. I'm going to do a quick word from our sponsor, and then we will be getting this party started. Thank you so much for being here. Enjoy. This episode is brought to you by our friends at VASA, the virtual assistant staffing agency. We hired our first virtual assistants from VASA to assist with our operations running the show back in June. But VASA is not just for podcast editors. If you need some extra hands to free up your time, let VASA help you with hiring for administrative, technical, and creative work. That's graphic design, cold callers, social media managers, sales reps, video editors, admin assistants, and more. Free up your time to focus on your highest impact work and learn more about VASA at vastaffing.agency or by clicking the link in the show notes to schedule a free strategy session with their team. Alrighty, back to the show.
Ali, welcome to the Lewis and Kyle Show. Thank you for being here.
Hey guys, super excited to be here as well.
Awesome. So my first question is, why has real estate traditionally been only for rich people, and what are you doing to change it?
Yeah. So historically, entering into the real estate market, the biggest barrier is definitely the upfront capital required to even get a deal done, let alone the ability to then go to a bank or a lender and get it financed. And so I have started a company with my co-founder, Amr Shafiq, called Getaway, which allows everyone, meaning accredited and non-accredited investors alike, to be able to fractionally invest in premier cash flowing short-term rental properties. And once you become an investor, you earn rental income as well as appreciation on the property when it's sold after the hold period. And then one added benefit just to throw in there about Getaway is all of our investors actually can stay in the properties they're invested in and the entire portfolio of homes at member-only discounted rates. So our product is not only just a real estate investment product, but also an investment in your travel and lifestyle.
Now that is something that's very unique that I wanted to touch on. I don't think there's any other investment product that gives you both of those things. And people would say or liken it to a timeshare. So let's go ahead and get that out of the way. Why is it different?
Yeah. So with a timeshare, you're just buying the right to use a specific property. You have no rights to the actual, title or deed or ownership of that unit. So with us, first and foremost, you're buying a percentage of a physical property. And with that, you get the economic benefits of the performance from the home, whether that's rental income or appreciation. So again, first and foremost, you're buying a fraction of a home versus just buying time to use it.
Are you buying these properties with leverage?
Yes. So when we assess every deal, the financing market is constantly changing. So we're along for the ride with that. But when we assess every deal, we look at it both from, okay, if we're able to achieve, 70% leverage, 60%, 50%, what does that look like from a return profile and, a future looking IRR? And we'll determine basically at the property level. But the first properties that we have in the portfolio both have over 60% leverage on them.
And is your offering the equity or is it the total?
Offering is the equity portion.
Okay, interesting.
So as an investor in Getaway, you're buying a slice of the equity. We've structured the debt side as non-recourse debt. So the debt lives with the LLC that owns the property, and you're buying ownership interest into the LLC. So God forbid something happens, like an investor is not liable for the debt on the property individually.
How do you underwrite? And this will be the last, maybe the last one. How do you
underwrite? We
started
out with the rapid round. Flip the script.
How are you accounting for lost revenue when basically, how are you assuming how many times the members will stay in the unit?
Yeah, it's a great question. So traditional short-term rental operators right now, like we rely so heavily on channels like Airbnb and VRBO. Like, they've created such a pool of demand. It'd be silly not to. And I think anybody you talk to in the space is going to say those are their two biggest channels. But there's a flip side. By creating all that demand, they take a hefty fee in the process. And so every time you go and book an Airbnb for a guy's trip over the weekend, you are paying an extra, I believe, 14.2% as a guest. And then the host is paying an additional 3%. And that is not only on like your accommodation fare, but that's on accommodation plus cleaning. So it ends up being like close to 18% total that Airbnb is collecting in addition to what anyone's making there. So as we thought about, building out incentives for our customers, like right off the bat, we knew that if our members booked directly to us, like we wouldn't hurt our underwriting revenue if we could stay within that 18% and pass that savings essentially on to our investors for being able to stay directly in their home. So with that, it really actually evens out in the portfolio where the actual property is not taking a huge hit, if a hit at all, for investors to stay.
That's a really interesting answer.
Yeah.
Lewis, do you have a question?
I've got plenty of questions too, but you just had them at the ready, like you're pitching with a pitching machine. Tons of questions for me as well. I heard you make this claim on another podcast, and I'm curious. Gosh. No, I heard you make it twice, 2 podcasts actually. So I think it should be good. But I like Costco because they tell you that the gas prices are like the best within a mile of Costco. And back to the investing in the lifestyle and the super unique benefit, less on the investment side, more on the consumer side, is you said that your rate as a partial owner, or depending on the tier level, is going to be like your cheapest accommodation for that comparable thing within that market. How are you, I guess, doing the price checking to back that one up? And maybe you can actually explain the guarantee correctly instead of me trying to explain the guarantee correctly.
In terms of, members assessing opportunities to stay in a market, we, first on the pricing side. So we use dynamic pricing tools to really make sure that we're competitive to, our competition, but also trying to drive the highest occupancy as possible. Because, one thing that's really big in the short-term rental game is like the higher the occupancy you have, at the end of the year, your top line revenue is going to be better. Like the more you can optimize for midweek bookings and things like that. So we're constantly changing the price. Like on a daily basis, there is a algorithm that is looking at like what is competitive in the market and how do we stack rank against, everyone in our neighborhood with the same criteria or characteristics of the property. And then we also have a human in the loop that's like validating those assumptions to make sure that, the algorithm is on point. So from that perspective, that's how we know we're within range of what's happening in our specific market. And then from a guarantee point for our customers, it's just where the discounts and the bonuses come in for being an investor of like, okay, so you have two houses on the same street that have the exact same characteristics, both have a pool, can sleep the same amount of people, and are listed for $500 a night. If you're an investor with Getaway and you get 20% off every night you stay there, like obviously like it's a better choice than going next door to the same home. So I won't say like put a big asterisk. I won't guarantee that no matter what, we didn't like there wasn't one property that snuck through that ended up being a little bit cheaper, but definitely on average, the idea is if you're going to a market as an investor that has a Getaway property, you should check it out first because likely it's going to be a better deal for you than going through something on Airbnb.
This might be like an algebra question. So I don't want to put anyone on the spot to do hard maths, but is there an optimal ratio? Yeah, right. Is there an optimal ratio of the occupancy from members versus non-members? I don't know why my brain went there, but I'm like this with the numbers. I'm like, well, that's a big discount to 20%. It's like, have you thought that through?
So
there is no actual,
yeah, actually it's, to Kyle's point, like really the discount is coming from like not paying the third party service provider. So as an investor, I'm getting a discount to market, but I'm also not because you're booking directly, but I'm also not hurting my investment as like in the property and its performance. If that makes sense.
Because the net number is the same to Getaway. To
the owners. So the owners are making the same revenue.
To the LLC series. So tax implications. Do Getaway investors benefit from depreciation?
Yes. So the way that we are structuring on the tax side is like very much, looking for ways to one, reduce everybody's tax burden on property. So like want to take advantage of as many deductions as humanly possible for real estate. So depreciation is a huge one that can really, help your taxable income yearly, especially like for our business, like operating expenses, like property management fees, those types of things can all be deducted from the taxable income. But we are approaching each individual property as a corporation. So instead of doing K1s, we'll be doing 1099s and we'll be applying for REIT qualification for each property.
Applying for REIT qualification for each property through what's that regulatory agency?
It would be through the IRS. It's applying is probably not the right verb there, but like hoping to qualify as a REIT for each property.
Do you have to meet all of the REIT? So are you going to have to report as a REIT, like FFO, have like?
But as a private, yeah. So it does.
Okay, interesting.
It creates a ton more back office work.
Right.
Well, it's kind of one and the same though, because doing K1s for thousands of investors is also extremely time consuming. So it's like, where do you want to spend your time? But we think that from a user perspective as an investor, if I'm only putting in $1,000 into a property, like for me to receive a K1, and I might not have other K1s that I'm doing, like your accounting fees to do your taxes will be higher than whatever you make off the property. It doesn't make sense for a small investor. And so we're really trying to position the product to really be as user friendly as humanly possible.
Love a user first company. That's what we love to
I don't know.
see.
Do you guys get K1s today? Like you might, because you're dabbling in lots of different things.
Do I?
I
don't
I'll turn
know.
the question to you. Does Fundrise distribute K1s? I've got a little bit in Fundrise.
I believe, I don't know which for all of their funds what they're doing.
Okay.
So I don't want to misspeak there, but I'm pretty sure
Mhm.
they do 1099s for some of the larger ones.
I mean, I feel like K1 was a new acronym to me today, and I do participate in the process of my own taxes.
I have a friend whose mom,
I'm calling
her
it
whole job
unlikely.
is preparing K1s.
It's
But I have a
wild.
question for you. Um, and I don't really know how to ask this question, so bear with me.
All good.
But like I want to use the word durability, but I don't think that's the right word. Like the value of a cash flow is in some way determined by its guarantee,
Yeah.
right? Like $1,000 cash flow from the government every month is worth more to me than $1,000 from Sally Sue.
Totally.
So in that same way, the value of cash flows from a short-term rental are worth marginally less to me than the same cash flow on a 12-month lease, right? So how do you like quantify that risk, or how do you think about that? And forgive me for not asking this question in the best way. I just think you might have an interesting answer.
Yeah, no, I think you're spot on. It's kind of like your risk adjusted returns, right? So with short-term rentals, like one thing you'll see right now in the market is like you're still able to get higher cash flow than a long-term rental property. And a lot of long-term rental properties, given where rates are right now, like won't even be in the black in terms of like month. Like you'll be lucky to break even. So there's definitely still that spread in the short-term rental space for the right properties in the right locations and the right operators. Like I will say that over and over again, like the operating of this asset class is extremely important, where it doesn't matter as much in the long-term rental space. So with that, I think as you're assessing the market, like I'd be really interested to see where people are in terms of their long-term rental rates. Like when you think of like a cash on cash yield, because what we're seeing on the short-term rental side is you can still, depending on how creative you get with leverage, you can still hit like high single digits, low teens on the cash on cash side. But that's because they're generating, 2 to 3 to 4 to 5x the revenue as it could as a long-term rental.
I have two questions. This might be more of a bonus question, but I might ask it now. Do you have a plan for the Scottsdale Super Bowl and Golf Open weekend? Because one of your properties is in Scottsdale, and that's like, I mean, that's like talk of the town is like how much you can charge per night because there's like the biggest golf thing in the world and the Super Bowl in the same city on the same weekend.
It's wild that they're hosting it all the same weekend. Like I'm still shocked that Phoenix, Scottsdale area can like handle that influx.
There's a lot of lanes on the roads here.
Yeah, fair. I love Arizona, by the way. It's like such a great market. I've been a little bit opportunistic in terms of how we're thinking about the Super Bowl weekend. And right now I've been holding off. By holding off, like I've set a price that I think is unreasonably high as like an opportunistic, like if somebody wants to book it for this rate, great, like good for all of our investors, but likely it won't get booked with the thought of waiting till we know who's in the Super Bowl. Because there'll be a lot more fans
that matters
to then book. And so that's been our approach right now. So we're like anxiously waiting. I can't tell you who's in the running, but I know that we haven't figured it out yet in terms of who's going. So we'll look at back to the dynamic pricing piece. Like we'll look at like what's reasonable based on what the neighborhood is doing for this home with those characteristics. And the second that we know, who's going to end up as the final two teams, that I'm going to list the price within what's fair.
Interesting.
Yeah.
I got a lot of stuff going through my mind right now about, so one of the limitations that I kind of see to this is like, you have to raise on a deal by deal basis. And if you're like this excellent operator and you have an edge, right? You're able to find properties and close on them. Like you can't wait. Like real estate is time of the essence, right? So like, are you going to close on deals and then sell your equity as the offering, or like how are you planning on beating that time problem?
Yeah, it's a great question. So, and this might be a little bit of a cop-out of an answer, but a little bit of both. So preferably like as a, VC-backed company, the last thing we want to do is buy properties and like have them sit on our balance sheet. And so our goal is to really identify opportunities, be able to put them in contract, raise the equity capital from our investors and close. Like that's ideal state for us. But if there's an amazing opportunity in the market that the timing isn't going to work, but we know that this is like a prime, like straight down the fairway type of investment for us, we'll definitely be open to closing on something and then listing it as an investment.
But you can do that though.
Yeah.
Okay, cool. That's sick.
I got a question. If you're on pause here, if your time is not of the essence in your brain at present, but I got an iPad. This is my first podcast with the iPad as the note question. So I'm just having so much fun with the handwritten iPad notes. But so I'm just going crazy with the prep here.
Are you doing Are you doing the ones where
no, go ahead.
You type it and it turns to text?
I'm not doing that. I kind of like my handwriting. So I don't know. I feel like it's a lot. It's more intimate. The world of handwriting. Right. And so the person we're interviewing in a few hours, their assistant had messaged me today. Do you know, like one of the guests wanted to know the questions in advance. So I sent a screenshot of like my chicken scratch notes. And I was like, if you can't read this, let me know, but I'm not going to transcribe this for you. And they said it worked. So
great.
It's readable. And, yeah. Nick Gray's assistant is able to read handwriting.
I'm not going to transcribe.
I'm going to send you my written notes. Like, see if you can read it.
Yeah. It's like, I did prep, so we'll see, but he's also like a good talker. But the question I have for you is division of responsibilities between you and your co-founder, because it's not super clear to me what you do. What he does seems like you're capable of answering every question about the business, but I can't imagine you're day-to-day responsible for every single thing.
Yeah. So so my co-founder, Amr, and I, we actually worked together previously at another real estate startup called Bungalow, and had the chance of, I led a lot of the business initiatives and different teams on the side of the business. And he was leading product and design and like really interfacing with the engineering team. And just complement each other's skill sets in so many different ways. So we're taking that into Getaway, where he runs product, design, engineering, and then I run the different business functions, whether that's like supply acquisition, operations. I will say we like split marketing. Like we both spend a ton of time in terms of user acquisition and figuring that side out. But that's basically like our divide.
I have a lot of questions I could ask you about marketing. Less so about Kyle kind of led the show with the beginning with the real estate technical questions, which we may have more of. But at least in my role in the company I'm in, I've been more so in the marketing side of things, and less so on the marketing the properties themselves. We've kind of covered that. You have the internal network for the owners to get through the getaway.com or whatever the proper domain is. And then Airbnb, and kind of just no one has to know, like it's not necessarily interesting to the person buying a vacation rental unless they're an owner that it's on Airbnb or Verbo. But for go-to-market strategy for investors, besides obviously being on lots of great podcasts like the Lewis and Kyle show, what else are you doing to raise awareness and find kind of those early investors? Because I believe you are, this is a question we usually ask early, you are like past launch, like you have fully, like this is an operational model. We're not speaking theoretical.
Yeah. So we have
everything we've talked about has happened a couple of times.
Yes. So we have 2 properties within our portfolio right now. One's actually live for investment. So we're, hit the ground running on all things like user acquisition and figuring out our ideal customer and where we're going to find them and so forth. So across marketing, like in true startup fashion, we're kind of doing everything, like, and trying to figure out like where really narrow down and like get a solid understanding of who our customer is, how do we message to them and where do we find them? There is like some benefit, like, we're trying to balance also the approach of like getting our name out there really quickly and paying for it, like on a paid social platform like Facebook and Instagram, versus, really building up more of an organic strategy from the ground up and figuring out how to turn our current investors into using a referral program and starting to grow more word of mouth, as well as like potential partnerships with creators across YouTube and Instagram and TikTok and other channels like that. So I would say it's very much a dual approach right now. Like we're definitely seeding a lot of just like building up our CRM with paid social, but then also really like trying to invest heavily in these channels that are more medium to longer term, where we can actually start to like grow our earned traffic versus paid traffic. Because I really think over time, this business like works really well as a referral, organic growth business. If you have to always buy every new investment, it just like won't work. So that's where our big focuses are.
I noticed on your website that it says that all disposition decisions will be done by Getaway LLC, which is you and your co-founder and your management team. What kind of, I guess, what will that look like for you? And like, how do you structure the incentives of that decision to make sure that it's what's best for the investor?
Yeah, it's a great question. The one thing that we want to achieve is that everybody walks away with, thinking this was an amazing financial decision. Like the more wealth we can create for our customer base, the better. So as we think about hold periods and when to sell a property, we're really like looking at the market and understanding like, how can we capitalize on the most amount of appreciation possible? Whether that happens in 3 years, unlikely, probably. Whether that happens in 7 years, more likely. That's how we'll be assessing from just, that lens of like, how do we make sure this is the best outcome for everybody? Mm-hmm. And then in terms of incentive alignment, one piece and one way that Getaway makes money is we do have a small portion of the carry, or we make essentially 10% of any profits post disposition of a property. So just to clarify what that means for anyone listening is all of our investors make their initial investment back 100%. And then anything that's left over, Getaway takes 10% of the profit. And then the 90% are distributed amongst the investors based on their percent ownership.
And did I see correctly that it's 10% on the front end too?
Yeah. So in terms of acquisition fee, we position, so it will vary property by property. Like our property we're launching in the Havana, in Miami, called the Havana. It is in Little Havana. That property will have a 5% acquisition fee. So that's one thing as we're learning and like launching this product, we're super open to hearing customer feedback and like understanding like where are some of the pain points. And one piece of feedback we heard was like, how can we, figure out a way to lower up our upfront fees so it's more palatable for investors coming in.
Yeah, I mean, that's one of the levers that you can really move to increase the quality of the deal too.
So, exactly.
And it's all about IRR at the end of the day. So, I mean, that makes sense to me. It just floats.
Yeah.
But I wanted to ask about your real estate experience at Uber. What was that like? What did you do there? Yeah. They do cars, not real estate. What's that like?
So fun fact, Uber, well, at its peak, I can't speak to the company, since like 2017.
Present day.
But yeah.
No, it peaked when you were there for sure.
Exactly. Right. But at its peak, Uber managed over 1 million square feet of real estate throughout the globe. So it had a huge portfolio for a tech company, and especially globally. And it was really interesting because Uber had office, like corporate real estate, retail, and industrial, all within the footprint. Because one, obviously office workers, like full-time HQ, retail was driver partner centers. So a lot of stuff was like taking over old AT&T stores where drivers could come in and like sign up, ask questions, do trainings, things like take a break, things like that. And then industrial was all of the self-driving cars, and the whole, that program. And so the real estate team there was really focused on, no longer exists. But the real estate team there was really focused on, how to optimize all of those things, how to keep up with the growth of the company. And then for the period that I was with that org was a lot of, okay, now we were super regionalized. So like Uber would have an office in Columbus, Ohio. And then the period was like, we're actually trying to become more centralized and have big hubs. So how do we figure out the optimization of, moving those employees to Chicago, and then also like getting rid of the leases on the books in these like bespoke markets all over the world. So that was one of the biggest challenges to overcome, as well as at the time we were building the new San Francisco headquarters at the Chase Arena. So that was a huge project that had a lot of hands on deck.
Quick sidebar. Are you on Twitter?
I am, but I'm like not, like I'm such a voyeur.
I think you should really get active on real estate Twitter. I think that could be a really good
retweet
avenue for Getaway, because like the real estate Twitter people are the ones that understand real estate investing and they have enough money to travel.
Yeah.
So like, there's like 20,000 people that are big into real estate Twitter. So I think that would be a good avenue.
Yeah, it's a good push. I'm like, it's so awkward sometimes. Like, what does
Don't tweet from your phone.
What?
Yeah.
Don't tweet from your phone?
From the phone.
You got to do it on a web browser?
Do it on the browser with a real keyboard and treat it. Makes it feel more like a business process and like a personal, like, oh, look at me, I have opinions.
Do you guys
Twitter?
Like, no, this is like, tweet?
Lewis tweets a lot. I don't tweet at all, really, but I'm a voyeur as well.
Yeah.
Lurker.
Yeah. I need to post more on there. It's a push for myself.
Yeah. Too. Okay. Let's hold each other accountable.
Yeah. All right. Deal.
Twice a week.
But twice a week tweets. You got to get like a scheduling app and just try to keep the queue full. Like an app where you just dump them and then you have like drafts and then.
What do you tweet about?
But yeah, there's.
Lewis is a full.
I'm a primarily a shit poster first and foremost.
Okay.
Meaning just garbage, not garbage, but like
funny
having
stuff?
fun. It is. Yeah. It is. Well, it's just I'm entertaining myself at the very least. We could say I'm still finding my voice on Twitter.
If you started posting like threads about your time at Uber, like your real estate knowledge, about the short-term rentals, about Getaway, about people love
it's like 5 reasons story, to make your next deal. 5 reasons your next deal should be a short-term rental instead of another blah blah blah.
Oh, you're big threads guy.
Richard Furtick.
I don't know if it's that we're big threads guy or it's just threads are working.
No,
that's just going to get the retweets and get you more visibility, hypothetically.
I love it. Thanks, guys. But push. You sound like my co-founder.
For sure.
Our big thing right now is LinkedIn. He's like, you need to become a LinkedIn influencer. Like every time you post something, like we get so much engagement. I'm like, okay, I'm working on it.
That's a good point too.
Because like,
LinkedIn and Twitter.
LinkedIn again, like gears. Can't put this in the podcast, but like gears to people like have jobs. Like paid social events do not.
Well, I mean, that's not, in my opinion, that's just a fact.
Right? Oh, totally.
So I don't even see that as like a negative connotation.
We'll take it out there.
You
can't
for sure.
You can't say that and then
for sure. But I'm just saying, like, I wouldn't feel the need to qualify that statement. I'm like, People on LinkedIn are on LinkedIn. It's just like
totally
demographic data is demographic data. I don't necessarily apologize for it, for the patterns that we see. But where are you going at, Kyle? I had a question too. But perfect.
No, you go ahead.
No. So I've been kind of nerding out lately on internal tools in general. And because the business that I run, we're like data analytics and automation for primarily marketing agencies right now. But, that's one market. We're interested in serving a variety of markets as well. And I heard you talk on another podcast that you have some pretty fancy internal tools for like determining deal flow, right? It was like so nasty, like where are you finding your deals? And it was not like, well, I go on Zillow on my couch and whatever looks pretty. It was like, no, it was like you got like geofencing and things sounded pretty advanced. So walk us through like the internal tools for deal flow.
Yeah. So I'm super lucky because, going back to where my co-founder and I started, we actually had the opportunity to build, a lot of systems, processes, products, tools, whatever you want to call them, for sourcing deals, and basically being able to underwrite them, automated, like I don't want to say completely like using an algorithm because like I call it human in the loop. Like, whatever we plug in, all of our inputs could get us 85, 90% there, but you always need a person validating anything, especially in this world of real estate and these bespoke deals. But so I lean on him a lot, but we have the ability to, basically scrape all the deals on the market and, use our knowledge of market level knowledge to underwrite well and get us to that 85%, accuracy of like, okay, here's the stack rank in Miami of what will work and what will work as a short-term rental, especially because that's the biggest thing in our world is like regulation. So Miami, for example, there are specific streets that you can get a short-term rental permit for, and then one block over you can't. And so being able to like essentially create a filter top of funnel for all the deal flow that runs through that, like reduces your time sitting on Zillow or Redfin all day long trying to figure out like what's going to work, what's not going to work.
I have a listener question.
Could you sell those tools for? Yeah. Could I buy that tool from you for a different market? Yeah. No, I probably couldn't afford it. But Lewis, what were you saying?
And that's a viable question if you'd ever consider selling, productizing that tool as a spinoff.
Yeah.
I think that would make sense.
No, for sure. I think about it as like, could that potentially be like our AWS product? Like, are those the things that come out of, building this company that are actually like really useful for a greater subset of customers? So for sure, something we would consider.
Cool.
Listener question. We have Kyle and a close friend who also works very similar role to Kyle, but for health and life sciences properties.
Nice.
And that's not really related to the question. I was just saying he's in real estate. And he wanted me to ask you how you compete against if the other players in the space, such as like a Fundrise, or I don't know if he listed another one that, or at least I don't know if I copied it down, but if they were to launch a short-term rental product, what would you think about competing with the other kind of fractional real estate investment? Because right now I do think you have a pretty good monopoly on the short-term rentals, but if they were to enter that market, how would you all feel about that, or what would change?
Yeah, I think so. Going back to the operating advantage, so much of this market comes down to like how good are you at operating these types of properties, and we're so early in short-term rentals as an asset class in general that there's not like super established, gray stars of the world that are going to come in and like run your apartment building and exactly what you're going to get, and exactly the cost structure and things like that. Like we're still in like the beginning innings of this. So I would say first and foremost, like how well are they going to be able to operate, and are they going to outsource that management? Because one thing, that we're really priding ourselves on today is that we can like really operate these homes extremely well and better than the rest of the market. And that's just given, our property management background and things like that. And then second, I really do believe that we're offering something more unique on the stays side of the business and like really focusing on the member experience. So once you become an investor with us, it's not just about your like dollars and cents and investment into the property. Like it is about getting you to the home, being able to touch and feel your investment, sharing it with friends and family, like having that emotional pride of ownership more than just like I always say this, but like putting money into an app and like hoping it goes up and to the right. Like this is something you can actually like physically go and enjoy and experience. So making sure we hit that out of the park for our investors is so key. And that would be another area that I think like, we're starting early here. If we can get those things right, like it's going to be hard to beat that from an overall experience perspective. But I do think more and more people will enter the space. Like you're starting to see it like more. I believe that like on Airbnb's platform, they've surpassed like professional managers have now surpassed. Don't hold me to this, but like there's been a huge rise in professional management where like versus the mom and pop. So like we're starting to see this happen. But again, like a Fundrise of the world, like I don't know if they're going to be able to operate a short-term rental portfolio the same way as like someone who's starting from the very beginning doing it.
Speaking of it, go ahead, Kyle.
You had it loaded up, Lewis. What's up?
I did. Kyle and I this summer lived together for a month at a Wander Jaunt property in Phoenix.
Oh, yeah.
We got kicked out like 3 days.
When they went under?
Before. Yeah.
Mm-hmm.
Yeah.
Do you know why they failed? And is there a lesson
inside baseball there? Because Lewis and I are still pissed.
Do they give you your money back?
They tried to charge us more.
Okay, Kyle, you're being dramatic. They prorated the 4 unused days at the end of the trip. Just fine. But it because we were there for like 32 days.
Yeah.
So then they wanted to prorate us for the 4 days, but accepting that refund would knock us under a month, so then knock us under the monthly rate. So then the 20% discount was in excess of the refunds. And so I don't totally know what ended up. Honestly, maybe Kyle was right to be angry and I was just forgetful.
Lewis took care of it. I was too angry.
But do you know what went wrong? And is there a lesson you're taking from their model, or is it just not even similar?
So again, don't hold me to this, but I believe that Wander Jaunt started with a master lease model. So they would go in and actually lease the units, like these multifamily units, and then basically like create an arbitrage on the short-term rental income. And that was how they got supply to build kind of like, you could call it like a Sonder-like curated Airbnb apartment experience in these like multifamilies. Mm-hmm. I can speak from experience at Bungalow because Bungalow started with a master lease model. Bungalow was the previous startup I worked for. And when times are tough, like you hit a global pandemic.
It's a low interest rate. It's a low interest rate environment phenomenon.
When you hit a global pandemic and people stop traveling or there's eviction moratoriums and nobody has to pay, being on the hook for a fixed amount of monthly, rent, it's not a sustainable business model. So I'm guessing, if I had to guess and put a gun to my head, that's what I would think happened with them. But I don't know more than that.
I do have a quick question. Have you thought about a wording? And this makes less sense in the context of your business because you guys are managing it yourself, but I think that you have a management fee. Mm-hmm. So have you thought about awarding like a subordinated shares to property management in order to not have that cash flow out, but rather have the property management company be like a no one's following me.
No, but basically like pay your property manager with shares of the property versus cash flow.
Right. Exactly. And have that be the percentage that they would be paid per month. Like for big multifamily, it's like 3.5%.
Yeah.
Yeah.
The problem with short-term rental management right now is because like you're dealing with, you could have a turn, you could have 15 turns a month. So it's just way more hands-on, and people's expectations are much greater than your long-term tenant. Like, for example, I'm renting an apartment. There's an issue with one of the toilets in one of the bathrooms. Like, if my landlord gets there within the week, I'm like happy and I'm fine with it. Whereas like if that happens in a short-term rental, like it needs to happen right now, or you're going to get a bad review, and bad reviews kill your business. Like a 4 is a fail. It just is the way, like even in Airbnb, if you drop below like a 4.3 rating, they like tell you might get banned from the platform. So
that's the first line of your first tweet of why a 4 is a fail.
That's great. I love it. We should build out a whole content calendar.
Just ask GPT.
Yeah, right. So with that, the average property manager, so like VASA is one of the biggest managers in the space. They charge 25 to 35% of gross revenue to do that. So
wow, that's a lot.
It's a lot. So and to be honest, like there are significant costs of doing the property management for short-term rentals. So I just don't know if there's like enough there to make it worth somebody's time in terms of like giving away ownership percentage. If that makes sense. That's one reason why we love managing ourselves too, is like we care about making this work and we care about our investors. Like, like we're responsible in a lot of ways for the returns they hit. So we have the ability to like be like, okay, this property, we actually think we can operate it at an 18% property management fee and it makes sense for our business. This one, we really need 25% because it's just like way less revenue top line, but we can look at every deal and assess it at a deal level versus working with one of these partners that they're like, nope, we're 25% every time.
That's really
a lot of levers.
Yeah, a lot of different levers in that sense.
Let's do a couple rapid fire bonus questions here.
Oh gosh, be nice.
Oh, what's that?
I said, oh gosh, be nice to me.
Yeah, that's not the intention to be gotcha, just kind of indicating that we're nearing the end of the conversation. But what personal real estate investing are you doing or is most exciting in your personal real estate investing horizons?
Yeah, it's a great question. So my fiance and I, we have 2 short-term rental properties ourselves, which, are good learning grounds for myself, just in starting this business. And then we're hoping to start building out a long-term portfolio as well. We're super fortunate where, folks in our family are actually, brokers and property managers. So we like have that insider connection in a few markets where we can like easily scale some things. And we'll know that be taken care of.
If you're looking for multifamily in Birmingham, Alabama, or any of the Gulf states, really, just let me know. We cover 15 markets.
I love it. We should find a deal if we can figure out the regulations on something we could do as a short-term rental or even like mixed use.
Okay, we'll talk.
Kyle's all about that.
Yeah.
Okay. Interesting. I have some stuff in mind. I mean, and that's another thing that I want to talk
the idea
about.
segment.
We're really running out of time here, but BTR as an asset class,
which stands for
is
build to rent.
Built to rent.
Okay.
That is just like it's single family built to rent. They're really missing out on some short term rental income there, and I think that there's a big something coming. There's got to be. Maybe it's you. We'll see.
I love it.
Yeah, I've worked in BTR. We have a few deals out right now that are BTR.
Nice.
And I worked in BTR the last my last two like internships before my big boy job.
I love
So
that.
I think that there's a lot that there's like there's so many units in the pipeline for these BTR deals that, but the big problem, I guess, is that, sorry to ramble, but BTR doesn't really work unless you have high density or whatever, like or low density per unit where the land cost makes sense. And that doesn't really happen in markets where a short-term rental would be.
Yeah.
Okay. Glad we thought through that.
And then the biggest thing for the short-term rental space is like oftentimes the properties that do the best are like the most unique and like almost like not ideal long-term rentals in a lot of ways. Like, so that's one thing where like build to rent definitely like fits the mold of like, okay, like what is the ideal property for, you know, the nuclear family that's going to fit this like income bracket and so forth. So that's like just one thing to think about. Doesn't mean that those deals don't exist and can't be had, but just in general as a concept, they tend to differ in terms of like asset type that would work.
Right.
Kyle, any last questions from you?
We've
covered a lot of ground today.
We've covered a lot of ground. Where are you seeing lenders land on in terms of interest rate, like for these deals?
Yeah.
I guess that's a hard question to ask. Let's just say at like a 60% LTV, you know, something like that.
So just had a call today and was quoted. I'm trying to do the math because it was based on a SOFR. Basically, it was like best case scenario, like just under 6. More realistic is 8 today for our
folks,
type.
Today is Wednesday, December 5th, 2022.
Wednesday, December 5th. But now again, asterisk, that's a commercial loan for a short-term rental product that lenders tend to think, you know, you're
from an institution with a relationship. There's
exactly
a million things going on there. Yeah.
So want to asterisk that. But I will say, like, for a long-term rental, I'm sure you could get a little bit better rates. But there is some, you know, lenders look at short-term rentals with like some inherent risk. So.
Right. Well, I think that wraps it up for me and all my questions today, Lewis.
I'm in the same boat. We could go for a while, but we double booked ourselves here. The next tenants are taking over vacation. Ali, where can people find both yourself on the internet, maybe Twitter, maybe definitely LinkedIn?
Definitely LinkedIn.
And also the website for learning about these investment products.
Yeah. So you can check us out at getaway.co, so .co. And then, feel free to reach out to me on LinkedIn. I'm pretty good at getting back to anybody that does. So it's just Ali Nichols, ALI, on LinkedIn.
Awesome. Well, thank you so much for coming on the show. This is super fun.
Thanks, guys. This was awesome.
And that wraps up another incredible episode of the Lewis and Kyle Show. Thank you to Ali for coming on the show. My 3 takeaways. Number 1 is about underwriting, and underwriting in real estate specifically. In underwriting, there's tons of different levers that you can change or move in order to impact returns, a few of which have outsized impacts on returns. Number 1 being interest rates. Number 2, in this case, being occupancy. And number 3 being the acquisition fee that they charge on the front end and the fees in general. And those 3 things, because they can play with them, you know, they can find a better deal or a worse deal depending on the way that they decide to play it. And I just think that that's an important note for everybody that is looking to invest in real estate, is to, you know, focus on the levers and get those right, because if those are wrong, you can be really, really wrong and lose a lot of money. Number 2 is I kind of see real estate as like the edge in real estate is kind of on 2 sides. Number 1 is like pen and paper, being there in front of the deal and getting a understanding of what the actual asset feels like, looks like, what the street is like. And then on the other end of the spectrum, it's like high tech. You know, there's an edge there because not many real estate investors use these tools that Allie and her team have built to find really good deals. And so I think if you can do both of those things, you can really be successful. Number three is this concept of investing or rewarding investors with not only a financial incentive, but a real life, real world incentive, like being able to travel to the place and show their friends, share it with your family, etc. That is a concept that we haven't really seen much. Like this added benefit on top of investing is a whole new concept, and I think that we'll probably see a lot more of it in the next 10 years. So that was really cool to hear her take on that, and I thought that this was a great episode. Lewis, what'd you think?
Yes. I want to riff on what you just said there. So we have an interview scheduled with someone named Drew Glover. It's actually supposed to be today, but we just rescheduled it. And he has this idea he talks about called like Web 2.5, where basically Web 2 and Web 3 kind of ignore each other in the sense that like the Web 3 feels like they need to reinvent everything from scratch. And Web 2 feels like they should ignore concepts from Web 3. And I feel like Ally is a really interesting Web 2.5 startup in the sense of it's a very Web3 NFT-ish kind of idea of like, what are the perks of owning the NFT, right? It's like all these arbitrary real life benefits. I don't want to say arbitrary, that's the wrong word, but maybe abstract or random, right? You get a discount on staying at these properties if you make this investment. And that's like a sort of very Web3 native idea. Maybe not Web3 native, but super popular in Web3 startups and not super popular in Web 2. But Ally is also not really making any effort to be like, oh, and by the way, the properties themselves are NFTs and they're going to trade on the blockchain. So it's like taking a Web3 kind of business model thing that has become rather standard and applying it to a Web2 idea. So maybe we'll connect Ally and Drew and I don't know, maybe just send an email thread and they'll be like, good point, Lewis. And that will be the end of that. But my three takeaways. The first one is that she had success working with her business partner before. So I forget, this is like many episodes ago, I kind of made this analogy. It was one of our franchising episodes specifically. Maybe it was with Fran Bridge. What was his name? John from Franbridge. John Ostenson from Franbridge. Basically, that the idea being that when you start a business that's a franchise, right, it's like 8 out of the 10 things have been figured out, and you just need to figure out 2. And very rarely is it a good idea to start a business and need to figure out all 10 pieces and like figure out 10 new things from scratch, because it's like flipping heads, right? 10 times in a row. Just the more times you need to flip it in a row, the lower the probability is that you're going to get the successful outcome. And kind of the operating assumption here is that there's a minimum required successful subsequent in a row flips for it to be useful. The point I'm trying to make here is the fact that her and her co-founder have already been working together successfully before is a huge difference maker. Besides like, so the analogy is right, Kyle, if you and I started another project, I'd be confident going into it because it's like, well, we've already worked together for 3 years. So we know that piece of the puzzle is not going to be the cause of failure, right? It maybe the idea is bad, but at least we know that that's a variable acting in our favor. That was not a very concise way to say. That is really cool and gives me more confidence in her and her team. The fact that she's worked with this business partner for a long time in the past already. Takeaway number 2 is Allie's crystal clear on her advantages. The question of like, what are you going to do if Fundrise launches an offer like this, or if other fractional real estate investing platform launches an offer like this? She's like, they just don't have the bandwidth to hire an STR short-term rental operator like me. Like they're just going to not operate the properties as well. They're not going to decorate them as well. They're not going to, again, she's just like, that's the edge. And she was really clear on that. So I think the more you can clearly elaborate your advantages, the better you're going to sound on podcasts, but also probably the more likely you are to withstand competition when it comes up. And finally, this is kind of a cop-out takeaway, but at least I gave a riff with you at the beginning that became its own Web 2.5 takeaway. So this is takeaway 2.5 because I made another 2.5. But fractional investing is just super fun. I'm super glad we have these conversations. And I would encourage you, if you liked this conversation, to check out some of our other episodes on the topic. We did one with Stefan von Imhoff, who runs a content company called alts.co, which is all about alternative investments, many of which are fractionalized. And we also discuss with Kenny Rose, the founder of FranShares, which is fractional investments in franchises like Sports Clips, which is a really random example. That is always the one I give first. That's everything from me. I was rambly today, and I appreciate your patience with us. I hope that if you're interested in this conversation, you read about Allie, maybe send her a message on LinkedIn, maybe look at her platform. But of course, this is not financial advice. It is a podcast. Kyle and I know nothing and are just here to learn and have fun. Thank you so much for listening. I hope you enjoyed this. Subscribe so you know about the next episode, and we will see you there. Have a good one. Bye-bye.